it's finally happening. The S&P 500 is breaking down through one of the strongest upwards trending channels that we've seen in a long time. I'm going to walk you through where I think the market could actually go from here and how I make that determination with data. I'm going to walk you through how I use this same strategy to work through the 2020 market panic, to where I went in and bought the market with confidence, and hopefully this helps give you a little confidence as well. So let's dive in. So here I have the actual S&P 500 daily chart. So every single candlestick represents 1 day of price action. And what you can see is that we have seen some really strong support since the March of 2020 panic. This is actually the low of 2020 in March. And from there, we just kind of saw the market rip. And since then, it has not really slowed down. We have not seen deep corrections, deep pullbacks. This is a long time coming, because when you have a support level that's this strong in the market, I mean, look at how many times this support level held, right? Like, this was picture perfect technical analysis. For those of you who don't know, looking at the charts, that's called technical analysis. Looking at data is called fundamental analysis. So you can see from a technical perspective, the chart was showing a lot of strength at this support level. We created this channel where we had, resistance, and then we had this trend line of support. So now what we've seen is we are officially broken down through this trend line of support, which is a really key area. And, there are a lot of things going on fundamentally that are affecting this, particularly issues going on in China, and also just the overall sentiment of the market was starting to kind of break down a little bit. People were worried about the reopening of the economy. People were worried about the Federal Reserve. What was the Federal Reserve going to do? Were they going to start tapering asset purchases towards the end of the year? Were they going to start raising interest rates next year? The market was starting to kind of think about these things. And so all of this, combined has led us to this pullback in the overall S&P 500. So we've broken down through that key support level, which is huge. So you might be thinking, oh my gosh, what do I do? Should I panic? Should I, buy more? What do I do? Well, when March of 2020 happened, this was the exact same kind of strategy that I used to build confidence in buying stocks when the market was selling off. In the grand scheme of things, this correction, this is still very, very small, because when you look at where we've come from the March 2020 low here, you can see that this is really just a small little blip on the radar. This is not a very strong correction yet when you look at where we came from the 2020 low. So right now, we're about 5% off of the highs, the all-time highs in the S&P 500. So a correction is really, a nice correction is about 10% off the highs. Bear market territory is 20% plus off of the highs. It's very possible that this market could end up, putting in that 10% correction. But what I'm going to do is I'm going to cover with you some of the ways that I determine where we're going to go based on earnings data and projected forward earnings data. So you can see here that, we do have corporations that are actually generating revenue, therefore generating profits, and that is what is essentially backing the markets. And we use earnings data to try to figure out how to value a company or how to value an entire market based on whatever companies that are being represented in that market. So what we can do from here is we can actually look at what are the estimated earnings going to be for the S&P 500 corporations going forward. What that gives you is that gives you an earnings estimate that you can then calculate something called a price to earnings ratio off of. And that's kind of what gives us possibilities of where the market could pull back and give us an idea of where could be a good buy. So I really like the Yardeni earnings PDFs that get put out. This is some really awesome and free data that you can get your hands on. So what this is the S&P 500 earnings estimates. There's the Ardini estimates and then the analyst consensus estimates. And if we go down to 2022, we can see that the earnings estimates are around, they're both pretty much in line. So we'll call it even 220. So what this is saying is in 2022, the S&P 500 companies as a collective are going to earn about $220 per share. So when we get that per share earnings, or that forward estimated earnings is what this is, since it's forward to 2022 that we're estimating, once we get that number, we can then calculate a PE ratio, and we can find out what is the market actually trading at? What PE ratio is the stock market actually trading at? And is it high or is it low? So the price to earnings ratio is basically taking the price of, for the S&P 500, it's taking the price of the S&P 500 and it's dividing it by the estimated forward earnings per share, which in this case was that $220. So you can see that on average, this is actually a FactSet earnings report, another free tool. Literally just Google FactSet earnings insights, and you will be able to get a hold of this report. It's amazing. The average PE ratio over the past 5 years, it has averaged about 18.2. Over the past 10 years, the PE ratio was around 16.3, and you can see that represented here. So that is actually, you know, pretty low considering where we are today. Today, our PE ratio is sitting around 20. If you take today's price, which is going to be around 43.04, and you divide it by that 220 estimated forward earnings per share in 2022, then that's going to give you a PE of around 19.5. So if you actually look at this on a forward earnings basis, you can argue that the market is becoming closer and closer to that 5-year average, which is around that 18 PE. So the idea is that the market is usually going to revert back to the mean. Things got really hot and overheated in 2020, and now we're starting to see that if these earnings shake out and if the economy does recover like people are expecting, then the market, if it sells off any further from where we're at today, it could end up actually looking quite attractive, especially if it got below that 5-year PE average of around 18. So let's look at where I think the market could go based on that 5-year and that 10-year PE average. And I'm going to tell you how likely or not likely I think that is. If we take the 5-year PE average of about 18.2, okay, then we can safely say that if we take that 220 earnings estimate and you multiply it by that 18.2 average 5-year PE, that's going to give us a price target of around 4,004 for the S&P 500. Now, we're still a bit far off from that, okay? Let's look at what the 10-year PE average gets us. So that was 16.3. So if you take that 220 earnings estimate and you multiply that by the 16.3, that is going to give you a price target of 35.86. So let's mark these up and kind of take a look at how likely I think this is to happen. Here's about 35.86, about right there, about right there. So this is going to be your 5-year PE average, and then this is going to be your 10-year PE average. Okay, so personally, I think that getting to the 10-year PE average is not likely. I think it would take a very bad piece of news to get the market to sell off to the 10-year PE average again, and that would bring us to around 3,500. I don't think that that's going to be a likely scenario. What I think is a much more likely scenario is the 5-year PE average or this 200-day moving average here. Now, this may be a little technical for some people, but the 200-day moving average is a pretty key level that price likes to react to if it officially gets there. We haven't seen much of 200-day moving average tests over the past, year or longer. So it would actually be pretty healthy, I think, for the market to actually retest that 200-day moving average. And on top of that, that isn't too far off from the 5-year PE average. So this is kind of what I was doing in 2020 when the market was selling off and, we were hearing about the virus that was spreading and shutting down economies and so on. There was a lot of fear around that time. I was able to pull back. I was able to look historically. Okay, where have earnings been historically? Where are earnings supposed to be this year? What kind of earnings cut are we going to have to expect because of the pandemic? And where does that leave us on a price to earnings ratio basis? And how far off from the mean are we? So, a lot of people in 2020 were expecting Armageddon. They were expecting, 70%, 80% drawdowns in the stock market, some people. And, when I was looking at it, I was like, well, if that happened, the PE ratio would be single digits. It would be way, 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 way below average. And that wouldn't make any sense. So, that was kind of the logic that I was using to kind of guide me into a confident buying state of mind. So, when I'm looking at the markets here today and I'm looking at the 2022 forward estimates for earnings, I'm thinking that the areas that I'll be watching for potential dip buy opportunities or potential opportunities to buy more stock, if we've already broken down from this pretty key level here today. So I'm thinking the next possible level that we could see is going to be around this 4,200 price level. And the reason for that is because we have actually some resistance, some pretty strong resistance. This was actually a prior breakout that happened in the S&P 500. And now we have basically resistance that could turn into support. It actually already was support right here, right? This 4,200 level, it was already support on multiple levels. So I'm thinking that this level could end up being a pretty great place for the market to reverse. If the price still is weak going into that 4,200 price level, then I'm going to be expecting that 200-day moving average retest. And that's putting us around that 4,100 price level in the S&P 500. I think that would be a fantastic dip buying opportunity personally. And honestly, this video will help you no matter if you're an active investor who is out there trying to pick stocks, or if you're a passive investor who is just buying index funds or mutual funds and just passively buying them and setting it and forgetting it. Because honestly, when these opportunities come, when the markets do crack really key levels and correct, 10 to 20%, these are historically buying opportunities. And it can be an important thing to pay attention to, even if you're passively investing, because you may be able to accelerate contributions at just the right time. And, I say that obviously timing the market for most people is not going to be a good thing to do. You just want a dollar cost average into the market, into your 401k or whatever it is on a regular basis, so you're not having to think about it too much. And if you're doing that, great. You're going to be able to take advantage of this opportunity anyway. If you're dollar cost averaging in, you're probably going to have a deposit coming in soon that's going to go into these markets very shortly. But for those that are not dollar cost averaging in and that are paying attention and trying to add when things pull back, this is going to be an important concept to understand to be able to decide, okay, am I buying when the market is at a good value or not? So to just kind of recap how I determine how much of a value the market is when we do see these deeper corrections. First of all, I'm looking at the forward earnings estimates. I'm thinking about what could affect that. Is there something that's happening right now that could affect our corporation's ability to continue to earn and grow over the next year? I'm thinking about the average PE ratios over time because thinking about how everything usually tries to revert back to the mean. That includes these price to earnings ratios. Over time, they do that. Hopefully you picked up a few things, whether it was, how to find some data, how to think through the data. do the calculations, and it will, help you going forward when you do see these corrections. You don't want to be panicking. You don't want to be freaking out or upset. You want to really think about it methodically, and you want to be calculated with it so that you can stay the course and potentially add to your wealth by adding to the market during these opportune times. I think that we still have a little bit potentially to go here. I still think this correction is very small on the grand scale of where we've come from. The market literally doubled since March of 2020, and I still think that this correction is very, very tiny. But that's, we'll see what happens. If you actually look at that PE ratio data, then things start to make a little bit more sense. I'm curious what you think about this type of video, because I could do more of these. I love talking about the markets and pulling up charts and stuff like that. What are some things maybe you want to learn more about when it comes to this stuff? And stick it in the comments below. Smash the like button for me, and I'll see you next time.